150 points. There's a bit of a recovery there too, but still, of course, underperformance continues. But Aniruddha Naha, the CIO for alternates at PGIM India Asset Management, joins us on the show right now. Aniruddha, hi, good to be speaking with you. What do you make of the market setup? A lot of stocks have corrected because the headline index is down 10% from highs. But if you look at a lot of mid-cap and small-cap names, they've easily corrected between 20 to 40%. Are a lot of these names coming into your buy territory now or still waiting for some more correction?
Thank you for having me here. We've generally been positive on the small and micro cap space. I mean, that's a space where we believe a lot of stocks have corrected, and it gives you reasonable amount of earnings growth coming through in that space. Followed by the large cap, where we believe there is some amount of more correction due probably, because this will be the third quarter where the frontline companies will disappoint on earnings. The last two quarters have been pretty suboptimal in the sense the earnings were below 10%. I think so. This quarter will be no different, and hence from that perspective, this will be a good time to build portfolios in the large cap and small and micro cap segment. Mid cap segment, I think so, is extremely expensive, and that is something we will wait out and see how it plays out.
I'll take a lead from that. Hi, Aniruddha, it's Ankita who's also joining in. I'll take a lead from what you just said. Do you think this year is going to be, a outperformance coming in from the broader markets? I mean, will the large caps take center stage because the FI selling still continues?
So our sense is, see, finally, your returns are a slave of what kind of earnings the markets deliver. If the portfolios deliver good earnings, your portfolio will do well. Generally, this quarter and probably the next quarter also, the earnings will remain reasonably subdued. Government spending should start coming back, and that will hopefully drive some of the sectors up. But what we are telling investors, please use the next 6-9 months to build portfolios. Do not expect very high returns. I think so the returns even into the next couple of quarters will be 0 to 10%. So it will be a single digit kind of return that one can expect. But it will be a great time to go ahead and pick good businesses where, because of the near-term earnings disappointments, it will give you an opportunity to build portfolios around those companies.
Everything boils down to earnings, Aniruddha. Which are the pockets you believe might show a bit of a, outperformance when it comes to the earnings growth? Which are the ones which will lead the earnings growth and, deliver better than average returns?
I think private sector banks, after a long time, though the earnings might not be anything great in terms of growth, but it will not disappoint, and that itself is a positive. Secondly, I think rural India should start coming back. Water tables are good, MSP prices are high, earnings beside Manrega has also started doing well. So anything related to the ecosystem in rural India should start reflecting some amount of positivity. But the broader view is, I think it's going to be a stock pickers market, and hence people who are, fund houses who are able to build good strong portfolios of about 30-40 stocks around good businesses with reasonable amount of earning strength, I think they should easily outperform the benchmarks, and hence active management will definitely come back vis-a-vis the passives which have done well over the last 2-3 years.
An interesting point that you make, that it's a bit of a stock pickers market, that basket approach of sorts might not work this year. It's going to be very, very selective within the sectors as well. Could you talk to us about which are the segments that you've increased your, let's say, positions on? What's your cash level right now? Are you fully deployed, or have you started deploying a lot more?
So we've been running on the alternate side. We've been running our 10-15% kind of cash level across. We are positive on pharma, healthcare, rural, agri, and probably private sector banks to a certain extent. But in terms of pockets, frankly speaking, other than the agri-rural part of India, we have become very, very stock specific. Agri-rural, the only reason why we think as a basket could still do well, because this sector has just not participated, or this segment of the market has just not participated in the last a couple of years, and hence there could be some basket approach there, but otherwise it has to be very, very stock specific in terms of what we go ahead and build.
As we kickstart earnings today with the IT name, TCS is going to come out with its earnings today. What's your take on the IT basket now? IT has been, it has held fort, even when the markets were down. It has moved up quite a bit, but what do you expect from the earnings now that attrition and wage hike problems, have abated? And, are there any currency tailwinds that you see further? And also, what's your take on the earnings? And is this time where people will start taking profit in the IT names?
I think generally our positioning, since you asked, is we've got literally very low positioning or a reasonably large underweight on IT. I mean, I think stocks have done well, especially in the mid cap and small cap segment. We find them extremely expensive. If someone has to probably take a position, the mid cap, the large cap positioning probably would give you far higher comfort in terms of valuations. But otherwise, mid and small cap IT names look reasonably priced to perfection. Any disappointment could actually see corrections out there. So probably if someone has to be in IT, it would be a rejig from the small and mid cap to the large cap segments.
Sure.
But otherwise, can we go ahead and build portfolios beyond IT? Absolutely possible.
Okay, so perhaps look outside of IT, but one space which has been underperforming massively has been the chemical basket, and for a reason. But finally, do you see light at the end of the tunnel, and are you getting incrementally positive on some of the specialty chemicals?
So this is something that we've been debating internally. There is no doubt that the inventory levels, channel checks, etc., shows that the inventory levels have come up, and hence it should be a reasonably big opportunity. What the Indian markets are also betting on is that China will not be incrementally very aggressive. But from what we see on the Chinese economy side, there is reasonable amount of slowdown, which is reflected in their currency, their markets, and their bond yields. And if that is the case, they will continue to produce and export deflation outside. And I don't think there's going to be any difference in their thought process with chemicals also. The kind of chemical capacities that they have built up, they might just continue to do that. I think a lot of the chemical trade will depend on, over a longer period, will depend on how China behaves, what's the kind of discipline it maintains. But in the near term, yes, since inventory levels are lower, this sector might continue to give you a couple of quarters of good results going ahead.
On that note, Aniruddha, we'll let you go. Thanks so much for making time and speaking with us today. On to now some stocks which are